Carl Tannenbaum used to be a Fed economist. Now he's with Northern Trust as their chief economist. He's here to give us his view of the economy. Welcome, Carl.
Good morning.
All right, so at the most recent Fed meeting, the minutes said that a few members are angling to end QE. Will they be successful?
There's a growing middle ground in the FOMC that's getting quite nervous about the extent to which QE could kindle either inflation or the type of asset price bubble that the Fed just got through cleaning up a few years ago. As those conditions move around and as we get further in our economic recovery, my sense is that they will be successful in arguing for a tapering of quantitative easing before the end of 2013.
And what are you watching in the economy right now? We had a good Fed beige book this week, but we've also had a lot of turbulence in the stock market.
Sure. Well, the stock market by and large, though, has done wonderfully since it hit the bottom in 2009. And the wealth that's been created and the spending that kindles is one reason to be optimistic about the economy in the United States for the rest of this year. For that reason, we should be getting closer and closer to those benchmarks that all of us are watching in the labor market for signs that the Fed can begin to taper off and then reduce its involvement in our economy.
One of the Fed's main goals in keeping rates low is to keep people refinancing their house to get more money so they can spend more, to push prices up and make them feel wealthier. In recent bank earnings, we've seen bank refis slowing. What does this mean for the Fed's plans?
The Fed certainly had as one of its expressions of quantitative easing getting people to refinance, and in that they've been dramatically successful. But that seems to be tapering off, as you've pointed out. Once rates get down to a certain level, they can't go down much further. What the Fed would tell you, though, is that another expression of quantitative easing has been the rally in the stock market, which most people don't think would have been possible had rates not been low, along with a promise to keep them low. So we still have that going for us. The housing market, though, is probably reaching sort of the end of the benefit that it's getting from quantitative ease.
The 10-year still remains below 2%. If the economy is recovering, shouldn't we see that moving up? Is the Fed just doing such a great job of manipulating the bond buying in that market that it just stubbornly is going to stay below 2% even if we get a better economy?
I'm sure that my former colleagues would like to think that they have all power over the exact setting of the 10-year Treasury rate, but the reality is that a variety of factors come into play when determining the pricing of that bond. Certainly economic activity here is one of them, but then you have global flows into and out of our markets that are sometimes driven less by what's happening here and more by what's happening overseas. And certainly one of the themes during the first several months of this year has been the difficulty in Europe, which has certainly prompted portfolio reallocation in our direction. I'd also note that the recently announced decision by the Bank of Japan to become much more aggressive has pushed Japanese yields down, and there's certainly stories that there are flows coming from Japan into our markets.
All right, let's stay in Asia. China recently reported that growth is slowing there, no longer getting double digits. It's now around 7.5%, which would be great for us, but we're about half that. The Chinese slowdown is causing what a lot of people think is a crushing of commodities. We saw that in gold early this week. Do you watch gold?
I watch gold. First, I should offer some perspective. You know, the Chinese performance came in just below the expectations, and I think you were hinting a 7.6 growth rate is nothing to be sneezed at. China continues to be an engine of world growth and an absorber of commodities, and I don't necessarily think that's the main catalyst for what's happened to gold and other commodities recently. Certainly the news on inflation, which here in the United States is well below 2% on a year-over-year basis, is one reason why commodities which are seen as hedges against inflation have lost a little bit of their luster.
All right, the big question is whether or not Ben Bernanke can escape, a Houdini-like escape from all the bond buying he's been doing. He's been buying all those bonds. When he goes out, will people follow him to the exits, send yields screaming higher, to cause the big stock market sell-off, and all those dominoes will eventually fall? Can he do it?
Well, that day is coming soon, hopefully because the economy is improving, and if it is, hopefully our stock market anyway will have a bit more stability and not be so dependent on interest rates. But the Fed, by the time they're done, will own $3 trillion of securities that they wouldn't normally own. And winding those down or selling them obviously is going to be something that they have to do very carefully. In addition to the execution of the financial strategy, their communication to the markets about what they might be doing will be critical to keeping interest rates in a line and not rising so quickly that it damages either the markets or the economic recovery.
And you're confident Fed Chairman Ben Bernanke can do that?
They've had plans in place for a number of years, and I think the outlines are sound, but one never knows how they'll actually perform until asked to put them into place. So there are a lot of unknowns about how that'll work, and certainly it remains a risk for the financial markets.
The best laid plans of Fed chairmen and men
There's
often
that.
go astray.
Well, let's hope not this time.
Thanks a lot, Carl Tannenbaum. Thank you for watching The Street.